Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Richard Adair, and Simon Giannakis, the CFO from Pluribus Technologies, to give us an overview on the company. Pluribus trades on the TSX Venture Exchange under the symbol PLRB. The company is currently trading at $1.62 with roughly 16 million shares outstanding, or about a $26 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Great to get to know Pluribus, a name that we are not super familiar with, but we had a chance to talk with Simon, I believe, several months ago. So it's great that you guys have come to join us today and tell us all about the company. So I'll hand it over to you. You guys have a presentation deck. Start as you will.
Okay, great. Thanks, Trevor and Paul. So we're going to give a bit of our backgrounds and then go into an overview of Pluribus. So I'm CEO and co-founder. I've been in technology companies for 30 years. First half of my career was restructurings and turnarounds. So we'd go into distressed technology businesses, usually cut some costs and work with creditors, and then eventually sell them to strategics. So lots of M&A in that period, and I was CFO, COO in about 20 companies in 15 years, all different verticals, all different technologies. So it makes me very vertical agnostic when it comes to acquisitions, and we've taken that approach at Pluribus. The second half of my career, the goal was to have some capital to grow a business and not just package it up. So I joined in 2006 a company called Stability Solutions, also on the Venture Exchange. And it's a good model for Pluribus. It was two little software companies in InsurTech and Health Tech, combined about $2.5 million in revenue. We had a $30 million market cap at that point. We ended up eventually selling those two businesses for about $175 million, and really grew through a combination of acquisitions and organic growth, particularly organic growth through channel partnerships, which I'll talk about later on. And I'll pass it over to Simon.
And good afternoon, and thanks for everyone for joining us today. So Simon Giannakis, joined Pluribus in June of 2021, and it's been a busy time, as we're going to get to in our presentation. So we went public on the Venture Exchange at the beginning of 2022. We've completed 4 acquisitions in 2022 and 5 in 2021, and a couple financings along the way. So definitely a busy time here at Pluribus. Prior to joining, I'd spent the last 8 years with Enghouse Systems, a software consolidator on the TSX, primarily in an M&A role. So there I was able to, lead 35 plus acquisitions and integrate them into the various Enghouse verticals, helping the business grow revenue during that 8-year period from around 100 million to 500 million. So definitely met Richard, and I liked his model at Pluribus, which we're gonna get into. So I decided to come aboard and help the business accomplish, hopefully over the longer term, the same type of traction we did in Enghouse. So I'll turn it over to you, Richard. You can start taking us through the story.
Okay, thanks, Simon. And Simon, there was a question to increase your microphone if you can turn it up there. I heard you okay, but sounds like it's a bit faint. So, so a lot of people ask, where does the name Pluribus come from? It comes from E pluribus unum, which is on the US dollar bill, out of many one. So it's a neat Latin word for a roll-up. And so we are buying small, profitable technology businesses that are B2B in different verticals, and then rolling them up into one group. So we differentiate ourselves mainly based on the fact that we're all entrepreneurs, and we've run small to medium-sized technology companies. We understand what it takes to run a business like that. There's never a straight line. It's a lot of work. And so really, when we talk to founders, we're saying, look, we're operators as well. We're going to come in and help you realize your vision. We're going to help you take the business to the next level that you can see, but you haven't known how to do, or haven't had the capital to do, or the expertise, as opposed to some of the traditional private equity or strategic acquirers where they might come in and change everything, let go of people, close offices, and really don't enable the founder to realize their vision. So I think that's our biggest differentiator. So as Simon said, been very busy since we started in 2018. We did our first deals in 2019, and the types of deals we've done changed over time. So in 2019, we did 3 small deals, InsurTech, health tech, and an e-learning company. And they were all $1 to $2 million in revenue, 30% EBITDA. And in every one of them, the founder was leaving, if not immediately, within 12 months. So the model was really buy these businesses, prove we could transition founders, keep customers, keep employees, and then start to grow them at a nominal rate, 5 to 10%. So we were really pushing growth based on a rule of 40 that was heavily acquisition focused, and then a little bit of growth in these businesses. In 2020, COVID hit, and it forced us to relook our acquisition strategy. We were even looking at a property company in the UK at the time, and backed away from that. But we felt that we had a company in e-learning, the Learning Network. We're in the space. We had some management there. We should focus on e-learning because that was benefiting from COVID. So we did our second e-learning acquisition, Logic Bay, in September that year. And that was the first time we really had some financial backing. The first 3 deals were friends, family, colleagues, bank debt, preferred shares from vendors. In 2020, Canaccord came in and did a non-brokered private placement for $5.5 million. So we felt we had backing, and as you can see, the result of that in 2021 is we did 5 deals. So really accelerated what we were doing as we had a partner that could raise us capital. And in terms of those deals, we continued to focus on e-learning. So ICOM, Skillshare, and Pathways were all e-learning companies. We bought our first e-commerce company, Power, and then we bought DocMoto, which is in digital enablement, but is a document management company out of the UK. So our first UK acquisition. We then, as Simon said, went public in 2022. To date, we had raised about 25 million in equity, and we raised another 25 when we went public. With that, we did 4 acquisitions. Kessman was our first ed tech company, Social 5, our second e-commerce, Tortle, our 6th e-learning, and then Rowanwood, our first property-related business in the UK. It's the one we looked at in 2020, and we revisited in 2022. Once we understood the impact of COVID on them. And I think the difference along the way is doing slightly larger deals. So we really figured out that unless it's a tuck-in, 5 to 7 million in revenue is a sweet spot in terms of picking up some management, less customer concentration, different markets they can be in, and also founders. So as opposed to the founders leaving right away, in I think 70% of our deals since the first year, either one founder has stayed on or a management team that was really running the business stayed on. So it makes it much more scalable where we're not going in and running them ourselves, and takes us forward. So during that period, 13 companies, 74 million in capital, of which 50 was equity, 24 was bank debt. We've been funding initially with BMO and now with National, 50% of the purchase price, and on a very fast growth trajectory. So in terms of the 3 areas we focus on, or 3 pillars, obviously we're an acquisition-focused company. So we're looking to buy these small, profitable B2B technology companies. As I said, 5 to 7 million is a sweet spot. We don't go over 10 simply because we'd have to pay up significantly for that. And we've been in the 4 to 6 time EBITDA range, and you can't really get that kind of value above 10 million. So we're focusing on the illiquid part of the market. The integration part is really important. So buying a business that's run one way, owner-operator business, and then professionalizing them and putting in place the controls and procedures and structure to support growth is a big part of our value add. And during that period, we're not only figuring out what we have and establishing the culture, we're developing sales and marketing strategies, product roadmaps, and taking the business forward, getting ready for growth. And then optimization, we work with the management teams now in place to put together growth plans that can take us forward and increase EBITDA margins by growing very profitably. So our playbook, when we buy these companies, oftentimes these small ones don't have a sales pipeline, and if they do, it's not very robust. So we come in and review that. A big part of our value add is cross-selling, so we can get their products into customers of our other businesses. And really, we're professionalizing the operations. So for example, a lot of companies, despite being software companies, don't have scheduled releases, don't have a roadmap. They're just sort of building stuff when customers ask. So we treat them much more like a regular technology company with those sort of commitments and accountabilities. In terms of marketing, we use our e-commerce companies, Power and Social5, to help generate leads for these businesses. They all complain about the same thing. We don't have enough leads that turn into new customers. We spent some money on sales and marketing and digital marketing. It didn't work. So we're able to use our sister companies to add value and create leads for them. In terms of offshore development resources, Akesson, our EdTech company, has an office in Albania, and Power, our e-commerce company, has one in Kazakhstan. So these are captive offices. These aren't third-party offshore companies from India, for example, where there's high turnover and it's hard to manage. These are employees of the company and/or full-time contractors that are managed locally with people that are part of our group. So a lot of these small companies don't do offshore because they don't know how to do it or they've not been successful. So we can enable them to do that and get their cost structure down. In terms of our consolidation strategy, we'll go into the e-learning group shortly, but really what we want to do is buy companies within a vertical, combine them into one, have one single management team, one sales team selling the products and services, and have all their products integrated. So we want to have a bigger business that can compete better than the individual parts. And then the other thing we do, which I think is fairly unique, we engage the founders with some success fees to go and find other acquisitions. They understand the market, they have a network, they understand the needs of the business and the gaps we have. And when they call up a founder, they get their calls returned because they can say, look, I'm in your space, see what you're doing. You're in manufacturing, I'm in accounting, just sold our business to Pluribus. If you're ever interested in talking about succession planning, you should talk to Pluribus. And so we're really trying to create relationships that result in acquisitions more so than participating in auctions led by agents and investment banks. So as I mentioned, in terms of cross-selling, you can see we have lots of good logos for businesses we work with in all our different verticals. And so really, we always structure earnouts as not only a way to bridge value gap with founders, but to incent them to stay around and support what we're trying to do in terms of growth. And really, the unique advantage we have with that is large enterprises don't like to add vendors. There's such a hassle with compliance and security. They'd rather buy more products and services from existing certified vendors. So we're able to go into larger companies that are clients of ours and say, hey, for example, Sonic is the largest customer for our health tech company, Telemed. We're able to go in there and say, hey, we bought these e-learning companies. Can we help you with your e-learning? And through our relationship, was able to go in there and start building courses for them. So the Learning Network never would have A, identified that as a target, and B, probably gotten in there. So we're able to say to founders, when we have an earnout, we can bring you into all these logos and make the earnout have teeth, because there's a real chance to get warm conversations very quickly as opposed to long sales cycles. So recent acquisitions, as I talk about, these would be the 2022 acquisitions. Akesson Group was our first ed tech company that reflected in our e-learning results, but they're not corporate. All our other businesses were corporate training. And so really, when we bought this, we thought we'd like to get in that side of the market if we could find some strong operators that had a unique value prop. And really they're focused on how do we solve the teaching shortage. And they have different products to do that, Teachway, Classroom, and Schooly. I'm going to get into that value prop a little bit later on. But very good management team and a very large market that is growing very quickly. There's a massive teacher shortage. So in terms of Social5, our second e-commerce company, the idea around this was they are very complementary to Power's customer base. So Power is basically plugins for small and medium-sized businesses in marketplaces like Shopify and Wix. Social5 manages social media for small and medium-sized businesses, so the same target companies. And they have a very strong sales culture of selling to these small businesses. So we felt that their sales expertise and outbound sales would marry very well with Power's ability to drive customers to their apps, and that we'd have a more fulsome offering of social media management plus website optimization and conversions. Tortal, as I said, was our sixth e-learning company. This one's interesting because they're very strong in franchisors and franchisees. So really, they built their whole business around providing a learning management system and courses to onboard franchisees to help them sell, help them to generate traffic. And so growing their software sales in that space, it's a fairly lucrative white space. A lot of the franchisors that they're signing up aren't established ones. They're new ones that are growing very quickly. So they just don't have learning programs, and we can kind of start with them at the beginning and sell them software and courses and services as well. Then Rowanwood, as I said, our property related acquisition in the UK. So Rowanwood actually are people I worked with before when I was at Symbility, the company I mentioned. They basically provide asset management software for community housing in the UK right now, just in the UK. So basically, as opposed to the cities, the local authorities, which would be like town councils here in North America, use this software to inventory all their properties and then determine the lifetime cost to maintain them, and then schedule that maintenance and look at the ROI on if you change a boiler at this point in time, you're going to save this much in energy, et cetera, et cetera. So very strong business, very great footprint in the UK, and really our second property related acquisition as Assured Software is also in the space, though they're focused specifically on insurance claims. So the plan for growth, we're in a large market. So application software is $225 billion. We're in fast growing verticals. So e-learning, e-commerce, health tech are all growing rapidly. And so we think that we have large TAMs and we're buying good businesses in those verticals. And I think the thing that I always like to reinforce for people is if you think about B2B software in particular, that market started in the 80s with IBM, Microsoft, and all the founders who started their software companies in the 80s are all retiring now. And most of them don't have succession plans. They don't have kids that are running the business. So there's a huge supply of companies and plenty to go around in the consolidator market for technology companies. So we have great demographics right now. So in terms of targeting the rule of 40, as I said, initially it was about 5 to 10% organic growth and then 30 to 35% from acquisition. We're now looking at how do we grow in this environment organically faster than we originally positioned with the market as we ramp up to do our next round of acquisitions. So from an acquisition point of view, we've given guidance for doing 5, that the 5th would move into early this year. So we are expecting to meet that guidance and are working on that 5th acquisition. At the current share price, we're not looking to raise money, it's too dilutive. So we're really looking to build intrinsic value in the meantime, so that when it comes time to raise money again and the market comes back and our share price is up, we've proven that we can not only buy businesses, but that we can grow them at accelerated rates by investing in our key verticals. So we're making bets essentially, not huge bets, but bets in investing in e-learning, ed tech, and e-commerce. So in terms of e-learning, this is really the playbook for us on how we want to do things. So we spent about 1.5 years buying the 6 companies listed up above. The second year was integrating them all into one company under one brand, the Learning Network. And as I said, one senior management team, one sales team, all the products and services integrated. And the phase 3 is to promote growth. So we have a good management team. We want to invest in growth strategies, as I said, to grow faster than 5 to 10%. And so for the e-learning group, they are focusing on the US market. So what we've really found is that the pure learning management system software market is commoditized now, and there's lots of competition and prices are going down, not up. So we felt, how do we differentiate ourselves with what we have? And we've got very successful companies that have created learning solutions, not leading with the software, but with the custom course creation. And so we've had great examples of that in Canada with companies like Purelator and TD and Suncor. And we're now targeting the US market to do the same thing. And we're leveraging existing logos that we have from that other slide that are US clients that our other businesses have. We're taking clients here in Canada that can take us to the US. So we did some work with TD in Canada, and now TD Wealth Management in the US is using us. And then we're doing campaigns around this contents first strategy in the US, and we're very excited about that growth strategy. So in terms of EdTech, as I mentioned, they're looking to solve the teacher shortage. And really what we did last year is how do we wrap that together? Because they basically had 3 different products for 3 different areas of the market with 3 different buyers. And so our thesis was, if we can lead with, we solve the teacher shortage, and here's how we can do it, we could get to higher level decision makers. So particularly in the US, we're dealing with principals and superintendents. By putting our value prop and marketing it to solving the teacher shortage globally, we're getting to higher level decision makers at education centers of excellence. So that's where the superintendents in a district will report up to. And they are bigger decision makers that are trying to bring technology and promote ways to solve the learning loss problem from COVID. So we're finding really great success with that. And the conversation is, look, you need teachers. There's 3 ways we can solve that problem. We can use Teachway, our recruitment platform, to find you full-time teachers. And we've got about 1.5 million in our database and 50,000 a month signing up. So it's really a job board that can help you recruit. We can create new teachers using our classroom product. Basically, we can certify teachers online and create teachers and or licensed people who are teaching in classrooms that aren't certified. And then we can give you access. So our online tutoring platform, Schooly, comes with a bank of teachers that do part-time tutoring. We can give you access to other geographies to get you some support for your current workforce. So we're very excited about this. We're seeing a lot of great response to this from districts, not only in North America, but internationally. And we're very excited about this growth opportunity for CAS. Then in terms of e-commerce, so I kind of explained what Power and Social5 do. Specifically with Power, when we bought the business, we felt they were very B2B2C in terms of the small to medium-sized businesses in marketplaces like Shopify. The annual contract value was quite low, less than $1,000 a year. And so we felt if we could somehow focus on making them more B2B, or maybe go up scale a little bit in the SME market, we could get that ACV up. And so there's 2 steps to that. One is you can't really sell B2B software to somebody if they're downloading a bunch of individual apps, which is how it works in the marketplace. So they spent last year creating a platform called Power One, which has all of their best features and functions from their apps in one platform that somebody can buy. And then secondly, we wanted to find other distribution channels. They're selling those now in Shopify and Wix and BigCommerce and WooCommerce. But we're leveraging the Social5 team to sell that outbound sales to small to medium-sized businesses that aren't in those marketplaces. And the advantage of that is when you're in a marketplace, your pricing is limited because people can go look at the other apps that are out there and packages, and you really can't charge much more. But when you sell outbound, you're selling to small businesses that don't have that pricing reference point and really are buying on value and what the ROI is. And their reference point is a bit different. Even the companies we bought initially, like Telemed and Assured and TLN, they're spending $750 a month on SEO and Google AdWords and not getting the leads they want. But they're prepared to spend $250, $500, $750 a month to figure out how to get the leads they want. So the reference point is a lot different, and you're able to charge much more outside of the marketplaces. So we've got those 2 channels, and we're very excited about the growth opportunity to better serve these small to medium-sized business market. And I'll pass it to Simon.
Yeah, thanks, Richard. So with this slide and the next one, we're going to give you some highlights of our 2021 results and in 2022. So you can see just the trajectory, starts to increase significantly in 2021, which is when we did our 5 acquisitions, and as well we crossed the threshold of being EBITDA positive in Q3 of 2021. As far as the balance sheet, with cash on hand and available committed debt financing from our term facility with National Bank, we do have the financing in place to complete that 5th acquisition. So as we move to 2022, you can see the again positive trajectory and positive trajectory to EBITDA. The only commentary I would give here is there is some seasonality to the business, specifically the e-learning vertical, both on the corporate training side and the edtech side. So they generally have stronger second halves than first halves due to the purchasing cycle for their products, and specifically Kesson, they typically have a very seasonally strong Q3 that ties to the start of the school year and the recruiting of teachers that would go along with that. With this slide, this is all public information, but a couple things to give some commentary on. So from a shares outstanding standpoint, 16 million shares. In terms of dilutive securities, so there's some warrants that mostly relate to the private financing that we did in March 2021 that would expire I think at the very beginning of 2024. And then the remaining piece of that is kind of a normal management board stock option plan up to 10% of the issued outstanding shares. The exercise prices for the dilutive options and securities range from generally $4 to $6 per share. The other thing to highlight here is just there is skin in the game between the management team and the board that we're going to go into next with 14% direct ownership. As far as the management team here, they all have experience working in a software M&A focused company, so acquisitions, dealing with integrations. There's a lot of bench strength here amongst the team. And good continuity. Most of the team here has been here from the beginning of Pluribus. As far as the board, again, good board, good continuity. We've had good corporate governance for multiple years before going public, including an investment committee where we look over all proposed acquisitions in a lot of detail, with a lot of investment and Bay Street experience on this board. I'll turn it back to Richard for a few takeaways, and then we're open to questions.
Okay, thanks, Simon. So we're acquiring these small technology companies in markets with large TAMs, and there's plenty of supply. This is worth noting. We continue to have a strong M&A pipeline, even though we haven't been as active in the last 6 months. And that's because we're building relationships with these founders, and none of them are in a hurry. So, we build a good pipeline. It's not time sensitive. And then our management team has proven now after 13 acquisitions that we can buy these companies, integrate them, and start to grow them. And we're really excited about the opportunities in our 3 larger verticals that we're investing in to get accelerated growth leading into our next round of acquisitions. I think that's the formal part of the presentation. Am I right?
Perfect. Well, perfect. Well, thank you. Great job, guys. A couple questions right off the bat. The economy is starting to slow down, or the fear is that the economy is slowing down. We've seen certainly in the public markets, the valuations of a lot of these software tech companies have come down. Are you seeing sort of better pricing? Are vendors a little bit more willing to negotiate price? What are you seeing as far as the sort of the pricing environment out there?
It's a good question. We're already at the lower end of the range. So, once you're in the 4 to 6 times EBITDA, we're not seeing a significant decrease from that. If you get much lower than that, oftentimes founders won't sell. So, founders in these kind of businesses that are profitable are selling if they get the right deal they want and if they're ready. We're generally not talking to people who are retiring within a year and have to sell. So I would say that in our 4 to 6 times range, we're tending more towards 4 to 5 now, but we're not going down to 2 to 3. There isn't any fire sales in the kind of companies we're targeting.
Right. Perfect. And then, you've already mentioned that you're sort of down at the part of the market where there's not a lot of competition, but who do you usually see as a potential competing bidder?
It's an interesting question because oftentimes nobody, and really our biggest competition is the founder deciding not to sell. So the hardest thing with these small deals is getting them to close, because they can always say, you know what, I'm not happy with this. I'm going to wait another couple of years and collect cash. As I said, we're not in too many auctions because of the lower end of the market we're in. I would say that the odd time, a strategic in the form of a distributor or a business partner might be bidding. We've come across Constellation once, but not very much. So it's sort of a mixed bag, but I think usually because we're creating these deals and developing them, a lot of founders have said, when I got the call from, the founder of TLN, I took his call and talked to him and talked to you and, understand what you did. And then 2 years later, we did a deal instead of getting an email a week from private equity or Constellation or a strategic, I want to buy your business. So we're really trying to cultivate those relationships so that when they sell and they're ready to sell, that they're engaged with us. And the other thing we do around that, as I mentioned earlier about channel partnerships, we oftentimes partner with them in the interim. So if either party is not ready to transact, there's going to be some synergies there, particularly on cross-selling. So we often look at doing value-added reseller agreements with them to start selling their products or selling ours through their channel, getting closer together, proving the value, proving an earnout can work. And then when it's time to sell, we're even more likely to be the acquirer.
Cool. And then, I obviously noticed that a number of companies are international. How do you go and find your deals all around the world?
Well, the UK ones, one of them came from the relationship I had at Civility, our channel partner innovation group. 2 gentlemen from there went and started growing wood. So that's how I found out about that. The DocMoto deal was an agent that found us, I think just online. And then we inherited UK business through Skillshare, one of the e-learning companies that had a UK group of customers. So those really sort of came to us and somewhat happenstance. But our main focus is founders finding other founders and bringing us deals that way. But and I part of the reason we're in the UK, that's where we had our most success at Civility in terms of growth and profitability. And it's a very good technology market if you can get in there, and we do have some relationships there.
And Richard, when you're looking at these deals, I imagine there's a number of different reasons that you would sort of turn away from them. But is there any 1 or 2 big reasons? Like what usually stops the deal from happening?
That's a really good question. We're as we're focusing on our larger verticals, we're refining our criteria and versus the early days where we're just trying to get in some verticals. Now we're looking at pieces that fit. So some things you look at just may not fit in the strategy for a vertical. But I think generally, one of the gaps, even with earnouts, is founders have a certain number in their head. And some of them are very unrealistic, and you just can't do a deal even if you have an earnout because they're just unrealistic. So that happens to us a lot. And then, other times too, we have founders who, the way we approach it is, so what's your number? My number is X. Well, I can't pay that much unless your cost structure is different. If you're prepared to adjust your cost structure, then your EBITDA goes up and I pay on EBITDA and, I can hit your price. So we found that some founders are on for that, want to go for that, and then others aren't. And so that can result in not doing a deal as well. But usually as we build relationships over time, we kind of get to know what the founders want and need, and we're getting better at that as we go, quite frankly.
Mm-hmm. Now, when you look at the number of acquisitions you've done to date, what have you done really well? Maybe a specific deal that you've done very well, and then the flip side, where do you think that you've maybe made a misstep of some kind?
Well, I think really well as we're proving it out. I think that the learning network as a vertical strategy is a good one. I think that these individual small businesses can't grow the way the group's going to grow, can't respond to RFPs and get into larger companies, can't cross-sell on their own. So I think that buying these smaller assets, combine them into one, and then focusing on growth strategies is something we do well. And we're now, doing that informally with Power and Social 5. We haven't combined any companies, but they are working very closely together, and would expect to do that over time with Kesson as we look at acquisitions there. I think that some of the businesses are taking more work to get where we want, some of the smaller ones. So Assured Software, for example, it's taken us some time to get a strategy in place. And that one really got hit by COVID a lot because it's selling software to restoration contractors, and they were particularly hit hard during COVID. But we've now got a strategy around getting insurance carriers interested in some of our technology, and that's where I had all my success at Symbility, selling technology to the carriers as opposed to the contractors. So we've got the right management in, we've got the right strategy. We're piloting some opportunities with some carriers. So I think that one's taken longer to get where it needs to go. But I think the theme with all these businesses, and part of it comes from my restructuring background, it's not if you're going to create value, it's how long it takes. And then I think that if we can get a company bigger, like we put a bunch of pieces together, we can get there a bit faster, but inherently some just need a bit more work, and you get it there when you get it there.
Gotcha. And then, what do you see as the biggest challenge you face in the business? Sort of like what keeps you up at night?
I think that, we have debt service requirements and interest rates have gone up, and, that puts more pressure on us than otherwise. I think that the impacts of a recession, is it going to continue? We haven't seen specific clients cut things back, but we do see clients deferring and taking a bit longer to do projects. So, but I think really what I'd like to see, and doesn't keep me up at night, but it's my main concern. There's two parts to it. One is making us get more liquidity in the stock, because there's not a lot of liquidity irrespective of share price. And then secondly, with a better market and hopefully us getting out there into forums like this, putting up results, getting our share price up so that we can do more M&A and do accretive deals. So, that's our focus for this year, is to get to that place. And then along the way, hopefully recessions and interest rates and inflation don't frustrate our progress.
Mm-hmm. And then Richard, as investors sort of looking in the business more or less for the first time, what do you think are the key metrics or maybe catalysts that we should be watching out for to sort of determine how best to see if you're executing on your business plan?
Yeah, I think that's a really good question. So historically, it would have been the velocity of acquisitions. And then, as I said, we've slowed that down and we're focusing on growth. So I think that to me in the next, for this year, for the next 3 quarters, seeing the growth occurring in e-commerce and ed tech and e-learning, seeing that our investment strategies are working out and that we can accelerate growth. I think that's very important. We'll do our other acquisition, as Simon said. But the reason that's important to me is when the market comes back and when our share price gets up so that we can do M&A, we want to be able to show this playbook where you buy the little companies, you put them together, you support management with nominal investments, and then you accelerate growth. And then we go back to market, we want to do that again and rinse and repeat. So I think this is the key piece that we're now proving out, where, as I said before, it was rule of 40, almost all acquisition and a little bit of organic growth, but more of an afterthought. I think if we can combine accelerated growth once we get the businesses together and then do M&A. I think that's a really strong combination and somewhat unique versus some of the other consolidators out there. So I think watching our progress this year along that would be what I'd be focused on.
Mm-hmm. Well, fantastic. Listen, I've sort of ended my questions here. Is there any sort of key message or key takeaway you want to make sure that everybody walks away with today?
Yeah, I think that when you look at our company, because of the businesses we're buying, we're profitable. We have cash on hand. We're not looking to raise money because we need to. When we raise money, when the share price supports it, it's to do accretive acquisitions. So, you know, versus some of our peers of a similar size, I think we're in a very strong position. And as I said, I think that we are fortunate in our skill set at management, where we can toggle between accelerated acquisition growth versus accelerated organic growth. And then as we prove that out, I think it's a very unique offering versus our peers, and that I think people will want to invest in going forward.
Well, fantastic. Well, listen, appreciate the time you spent with us today. We've been speaking with CEO Richard Adair and CFO Simon Giannakis, both with Pluribus Technologies, symbols PLRB on the Venture Exchange. Guys, thanks for joining us today and look forward to catching up with you guys soon.
Thanks everyone for your time. Appreciate it.